Ever heard the one about the high-frequency trader who broke his computer? He tried to click buy faster than his computer could process it. Now that's a joke, but it's not far off from the reality of high-frequency trading, or HFT as it's often called. In the world of finance, HFT is like a cheetah on a caffeine rush, making a whirlwind of trades in the blink of an eye. Imagine a powerful computer and complex algorithms playing a high-stakes game of chess, except instead of chess pieces, they're dealing with stocks, bonds, and commodities. They're executing trades at such lightning speed, it would make even the Flash envious. This tech-driven trading approach has become a major player in today's financial markets, stirring the pot and raising eyebrows along the way. But what is it exactly, and why should you, as a trader, care? Well, dear listener, those are some of the questions we're about to tackle. So buckle up, because we're about to dive into the high-speed world of high-frequency trading. Imagine being in a foot race where your opponent has a jetpack. Doesn't seem fair, right? This is exactly what's happening in today's financial markets. The race between high-frequency trading, HFT firms, and average retail traders. High-frequency trading, or HFT, is like having a jetpack in the world of finance. It uses powerful computers and sophisticated algorithms to make thousands of trades in mere fractions of a second. HFT firms, with their advanced technology, have a significant advantage over the average retail trader. They're zipping around, making trades at lightning speed, leaving the average retail trader or our foot racer trailing behind. Now, you might think, well, isn't that just the way of the world? The big guys always have the upper hand. But here's the thing, this isn't just about being faster, it's about having access to a level of the market that the average retail trader simply doesn't have. HFT firms can see and react to market changes before anyone else. They have the ability to move in and out of positions quickly, often before retail traders even have a chance to blink. It's like they're playing a game of chess, already 10 moves ahead, while the rest of us are still figuring out our opening move. So, what does this mean for the retail trader? Well, it can lead to significant price discrepancies, and it can make it harder for retail traders to execute trades at the best possible price. This, in turn, can impact the overall profitability of their trading strategy. It's important to understand that this isn't a level playing field. The advanced technology and speed of HFT create an inherent inequality in the access to markets. And while there are discussions about regulations to level the playing field, for now it remains a significant challenge for the average retail trader. So in this race, the guy with the jetpack takes the gold, while the regular Joe is left in the dust. You know how a quiet day can suddenly turn into a thunderstorm? That's kind of like market volatility with high-frequency trading, or HFT. Imagine you're lounging on the beach enjoying the calm waves, then bam! Out of nowhere, a tidal wave crashes onto the shore. That's what HFT can do to the market. It can cause sudden, drastic swings in prices, turning a calm market into a wild roller coaster. HFT firms leverage the speed of their powerful computers and sophisticated algorithms to execute trades in fractions of a second. This rapid-fire trading can significantly amplify market volatility. Unlike the traditional trader who might make a handful of trades per day, HFTs make thousands, even millions of trades in the blink of an eye. But here's the kicker. These sudden price swings often occur without any change in the underlying economic factors. You may be wondering, how's that even possible? Well, it's because HFT isn't about investing based on a company's performance or potential. It's about exploiting tiny price differences for a quick profit. These price swings can create a volatile trading environment that can catch retail traders off guard. One moment you think you've made a smart trade, the next you're staring at a screen of red, wondering what just happened. But it's not all doom and gloom. Some argue that HFT can actually reduce volatility by providing additional liquidity to the market. However, this liquidity can be fleeting, disappearing just as quickly as it came, especially in times of market stress. This can leave retail traders high and dry, struggling to execute their trades at the prices they want. So, if you've ever watched the market and felt like you're on a wild roller coaster ride, you may have HFT to thank for that. This is the world of modern trading, my friends, where the pace is fast and the stakes are high. So if you're not a fan of roller coasters, HFT might give you a bit of motion sickness. Ever tried to take a sip from a straw only to find there's nothing on the other end? That's how liquidity concerns feel. Let's dive into this. High-frequency trading, or HFT, creates an illusion of liquidity in the market. Liquidity, in simple terms, is the ability to buy or sell a security without causing a significant change in its price. It's like having a pool of potential buyers and sellers ready to trade at any given moment. Sounds ideal, right? Well, hold your horses. HFT might make the market look like a bustling bazaar, but here's the catch. These trades are done at lightning speed, often in fractions of a second, and in very small quantities. So, while it might appear that there are plenty of fish in the sea when it comes to making a substantial trade, you might find the sea is not as full as it seemed. This is like seeing a long line at your favorite ice cream shop. But when you finally get to the front, they've run out of scoops. In the financial world, this scenario is not just disappointing, it's risky. It can lead to sudden price changes, making it harder for retail traders to execute their trades at the desired price. Now imagine a retail trader wants to sell a chunk of shares. They see enough buyers in the market, so they make their move. But in the blink of an eye, the HFTs have already made their micro trades and moved on. The trader is left with a bag of shares and no one to sell them to. It's a classic bait and switch. This illusion of liquidity can have serious repercussions. It can lead to increased volatility, as we've discussed earlier, and it can also distort the true supply and demand dynamics of the market. So, just like that empty straw, the market might look full, but when you go to take a sip, there's nothing there. Now, isn't that a bitter sip to swallow? But don't worry, we're here to help you navigate these choppy waters. Stay tuned for our next scene where we'll dive into the murky world of front-running and scalping. Ever had someone cut in line at the grocery store? That's kind of what front-running is like in trading. Now, imagine you're in line at the grocery store. You've got your cart full of goodies and you're ready to check out. Suddenly, someone zips in front of you, unloads their items, and checks out before you even have a chance to blink. That's front-running in a nutshell. And in the world of high-frequency trading, it's a common strategy. Let's break it down. Front-running is when a trader, often a high-frequency trading firm, uses advanced technology to spot a large order from a retail trader in the pipeline. They then race ahead, buy the stock at the current price, and sell it back to the retail trader at a slightly higher price. It's like buying the last box of your favorite cereal right before you reach for it, then selling it back to you at a premium. Not exactly playing fair, is it? Now, on to scalping. This is another strategy used by high-frequency traders. It involves making hundreds or even thousands of trades in a day, aiming to profit from tiny price changes. It's like spotting a bunch of small coins on the ground and scooping them up before anyone else notices. It might not seem like a lot, but those pennies can add up to serious bucks over time. The issue here is that these tactics give HFT firms an unfair advantage over retail traders. They're using their superior technology and speed to swoop in and make profits that should have gone to the retail traders. It's like being in a foot race where your competitor has a jetpack. Not exactly a level playing field, right? In essence, front-running and scalping are ways that high-frequency traders can use their technological edge to make profits at the expense of retail traders. And, while it's not illegal, it does raise some serious ethical questions. So, the next time you're in line at the store, remember, no one likes a line cutter, especially not in trading. Imagine if you ordered a pizza and it arrived half-eaten. That's sort of like poor order execution. High-frequency trading is a bit like a fast food drive-thru on steroids. It's all about speed, efficiency, and getting as many orders through as quickly as possible. But what happens when you're the little guy trying to place your order amidst all this frenetic activity? Unfortunately, you may find that your trades are not getting filled at the prices you expected. When a retail trader clicks the buy or sell button, they expect their order to be executed at the best possible price. But in the world of high-frequency trading, the price you see isn't always the price you get. Instead, you might be left with the financial equivalent of a half-eaten pizza. You see, high-frequency traders use advanced algorithms to spot orders from retail traders. They then race ahead to buy or sell the desired asset, causing the price to shift. By the time the retail trader's order is executed, the price has changed, often resulting in less favorable outcomes. This phenomenon, known as price slippage, can eat into the profits of retail traders. And it's not just about the price. Sometimes large orders get split into smaller ones to avoid moving the market. However, high-frequency traders can detect these smaller orders and take advantage of them, leading to partial fills or even unexecuted orders for the retail traders. Think of it this way: you're at an auction, ready to make a bid. But just as you raise your hand, someone else swoops in and snatches up the item. That's the reality of trading in a market dominated by high-frequency trading. It's important to note that not all aspects of high-frequency trading are negative. It can provide liquidity and reduce bid-ask spreads. However, for retail traders navigating this landscape, it can feel like they're always a step behind. So, if you're hungry for good trades, watch out for the high-frequency trading pizza thieves. Ever feel like the rulebook is written in another language? Welcome to the world of HFT regulations. High-frequency trading, or HFT, might seem like a wild west where algorithms and computer systems rule the roost, but it's not without its sheriffs. Regulatory bodies worldwide are grappling with the challenges and concerns posed by this form of automated trading. One of the main challenges is staying up to speed. The rapid pace at which HFT has evolved has left regulators scrambling to keep up. High-frequency trading is like a cheetah, sleek and fast, while regulations can often feel more like a tortoise, slow and steady. There are concerns that the current regulatory framework isn't equipped to handle the complexities of high-frequency trading. This can create a kind of regulatory fog, where it's unclear what's permitted and what isn't. And in this fog, it's often the retail traders who find themselves lost. One of the key concerns is the lack of transparency. With trades happening in the blink of an eye, it's challenging to monitor and track high-frequency trading activity. This lack of oversight can potentially lead to market manipulation and unfair practices. Another issue is global coordination. Financial markets are interconnected and HFT is a global phenomenon, but regulations vary from country to country. This lack of harmony can create loopholes that could be exploited to the disadvantage of retail traders. Regulators are indeed making strides in addressing these concerns. They're working on creating rules that can keep pace with the rapid advancements in trading technology. They're also exploring ways to enhance transparency and improve market surveillance. But it's a marathon, not a sprint. So retail traders, it's important to be aware of these regulatory concerns. They impact the trading environment and consequently your trading experience. Staying informed can help you navigate the high-frequency trading landscape more effectively. So, navigating the HFT rulebook can feel a bit like trying to read hieroglyphics without a Rosetta Stone. But remember, knowledge is power. The more you understand about the regulatory landscape, the better equipped you'll be to tackle the challenges of high-frequency trading. Well, that's the end of our high-speed journey into the world of high-frequency trading. We've covered a lot of ground, so let's take a quick pit stop to recap. We started our excursion looking at the unequal access to markets. High-frequency trading is like being in an exclusive club, where the entry fee is an ultra-fast computer and a sophisticated algorithm. It's like trying to compete in a race where some folks have jetpacks while others are left with running shoes. Next, we dove into the turbulent waters of increased market volatility. High-frequency trading can whip up a storm in the sea of stocks, causing waves that can capsize the small boats of retail traders. It's like trying to surf a tsunami with a boogie board. We then navigated through the murky depths of liquidity concerns. On the surface, high-frequency trading can seem to increase liquidity, but, as we found out, it's more like a mirage in the desert that disappears just when you need it most. Our journey also led us to the shady alleyways of front-running and scalping. Here, high-frequency traders are like pickpockets, snatching away profits before retail traders even realize they're gone. Next, we examined the impact on order execution. With high-frequency trading, it's like trying to catch a bullet train while it's speeding past at full speed. Lastly, we delved into the regulatory concerns. It's like a game of cat and mouse where the mice are armed with rocket boosters and the cat's still figuring out how to open a can of tuna. If you found this journey informative and interesting, remember to hit that like button. It's like giving us a high five, and who doesn't love a good high five? And if you want to join us for more financial adventures, don't forget to hit the subscribe button. It's your ticket to this wild ride we call the financial market. Thank you so much for watching and supporting this new channel. Remember, every like, share, and subscribe helps us bring you more content. Until next time, keep your trades smart and your spirits high.